Now we're going to look at the selling bonds at a premium using the effective interest method, which is the preferred gap method. Again, to review, the contract rate equals market. That means it's sold at par, but if contract is greater, your bond will sell for a premium price, and if contract is lower, it will sell for a discount price. But why? What drives the price up or down? Well, first think about demand for your product on the stock market. The contract rate, remember, that's the actual cash interest you pay, but the market rate, you can think the stock market demand. Now, there's a little more to it. But start by thinking, what is the market willing to pay for your product? Well, what's it worth today? So principal is a one-time payment, and interest is that recurring payment. What are those worth today? That's how the price is calculated. So think stock market demand. What price is the market demanding? But in reality, it really does all have to do with interest rates. Although the market does have an influence on the Fed in whether or not they will raise or lower interest rates, in the end, it's the calculation, the price is present value of all future cash flows, the principal and interest. So we're going to look at an example with sold at a premium. Your bond is paying 8. Other bonds out there are paying 6. 5-year bond, compounded twice a year, means compounding periods N is 10. And I will be cut in half. 3% the first 6 months, 3% the second 6 months equals an annual market rate of 6%. So make sure you choose the correct table value. Present value of 1 table is used for the principal. Present value of an ordinary annuity is used for the interest. For the bond present value or the selling price of $108,530, sold at a premium. Remember, the contract determines N, market determines I. The initial issuance of the bond with a premium on bonds payable, that adjunct liability. So in accounting principles, usually the straight line method is introduced, and then on in intermediate accounting, the effective interest method is covered with a comparison to straight line. The effective interest method is the preferred gap method, but the straight line is allowed for cost effectiveness. So amortization of the bond premium. First, real quick review of the straight line method. You simply take the total premium divided by the total compounding periods, 10 if it's a 5-year bond. And here is your journal entry. The premium is absorbed in interest expense. Notice your cash payment based on the bond indenture. The contract rate is $4,000. That will not change. But the interest expense is lower because of that amortization, which means your tax deduction is going to be lower than your actual cash outflow. But that's okay because you got more money up front. It all evens out in the end, whether it's sold at a discount or a premium. But the effective interest method, this is thought to better follow the matching principle. It accrues actual expenses more accurately. Accrual accounting, remember, that is GAAP. The effective market interest rate of interest is multiplied by the outstanding balance of the debt. That's how you calculate it. So it's very similar to a note payable amortization table. So first, the initial bond present value, that's the selling price, that's the initial carrying value. Face value minus the premium, or plus the premium on bonds payable. This is how it's recorded on the balance sheet. And of course, it has to equal $100,000 at maturity. Best to use an amortization table. So the life of the bond, 2016 to 2020, the cash interest paid based on your contract will not change, using the effective interest rate when it's sold at 6%, so 3% semi-annually. Multiply the carrying value by the 3%, that is your interest expense. So you're really backing into premium amortized. Where with a straight line, you calculate how much is amortized, and you're backing into interest expense. So the differences really are, what are you solving for? First year premium amortized $744, but the carrying value is changing, so how much premium is amortized changes. $4,000 stays the same, but the carrying value is decreased, so multiplying the decreased amount by 3%, you have a lower interest expense every year. Part of that is the premium and part is the expense to equal the cash payment. Notice it keeps going down. And this is different than straight line because straight line is an identical journal entry. The effective interest method, it will change. Carrying value, 104,579 times 3% equals an interest expense of $3,137. The difference is how much premium is amortized. So with this method, you're calculating interest expense, backing into how much of the premium will be amortized, until finally, at maturity, you've reached face value. Premium is fully amortized off the books. Here are your totals. And you record the final journal entry to remove the bond payable from the books. Remember, the premium on bonds payable is an adjunct liability. The discount was the contra liability. And again, looking at the numbers, difference if contract equals market, it's sold at par, and the numbers below simply prove it based on N of 10 and I of 4. Bond present value, $100,000 face value. But if contract is higher than market, market is 6, but you're paying 8% annually or 4% semi-annually, you use the 10 compounding periods, but you're using 3% instead of 4% because you follow the market rate. And as you run the numbers, you can see this sold at a premium price. Contract equals market, bond sells at par. If other bonds on the market paying 6, but you're paying 8, that's going to drive the price of your bond up. It's sold at a premium. It's the best way to remember it.